few others to join. I'm just going to run through a little bit about Alpha Wealth and today's session. Basically, we as financial advisors give independent advice to individuals around really three main areas, and I generally tend to segment them in terms of things like savings and investments. And obviously today is primarily centered around, as I said, savings plans for children, although not specifically for that purpose. I think everyone should save, and I say that as a parent, but also as an adult. The other area that I tend to focus on with my own clients are the retirement savings. So it's really about making people aware of the option, especially this time of year when we're all looking at the tax that we pay or have paid this year and how we can look to mitigate that. And then the third area is in the area of protection. So typically looking at people making sure that they are adequately covered if they are sick or indeed unwell, or if they unfortunate enough to have a serious illness, or in terms of protection, things like mortgages. So without further ado, I just get started. I'm conscious of time today, and thank you very much for joining the webinar. For those of you that didn't hear, my name is Nick Sean-Ambus. I'm the Managing Director of Alpha Wealth. I'm joined by a few of my colleagues today. The other financial advisor in Alpha Wealth is David Looney, whose picture you can see on the screen there. That was pre-COVID, obviously, at an event that we ran in Fota Island Resort last year, which we've done a few of these kind of sessions. Obviously, we've gone online now, but as I said, they've generally tended to be well received. So basically, in terms of the session today, we wanted to talk to individuals around the options that there are out there. It's a really difficult environment, as I'm sure most of you are aware. We are in, I suppose, a situation where the interest rates from the banks are down to negligible levels. We're seeing banks starting to actually charge people to hold deposits. Interestingly, N26, which were a German bank, were the first bank to announce about 2 weeks ago that they were going to charge personal depositors for balances over 50,000 for holding money. And I think it's going to happen at smaller levels for most of the general institutions. AIB have already indicated that they're most likely to do that. So, as I said, that's what really kind of, I suppose, enabled us to come out today. The first thing to mention is that we do not charge for the advice that we give. There is no obligation to take the advice. And the key thing, I suppose, for anyone who is listening today is that if you have a savings plan in place for your child, it's worthwhile knowing what the options are for you, and obviously looking at the costs of these schemes and really what you get from them. So just to start off and say that traditionally, when we had a choice of our savings, it was either do it in the bank, and generally speaking, the bank, the post office, the credit union would have offered fairly reasonable rates for savers, particularly for children's accounts. Unfortunately, over the advent of the last couple of years, particularly with what's been going on in the world, interest rates have fallen, hence deposit rates have fallen, and hence the returns that anyone gets from the deposits has been removed. So what we're really focused on with clients is that there are options out there with the insurance companies. And the one that I want to focus on today with you is through Zurich Life. Zurich are one of the biggest companies operating in Ireland. They're headquartered in, I suppose, in Zurich, obviously. And they have provided, and sometimes people think of them as a pure insurance company, but they are one of the largest pension providers in Ireland and also one of the largest savings companies. And typically the plan that I want to focus on with you, I think, is the best of its type. Now, before I go into detail in terms of the plan, what I wanted to do is just give you some information around the, I suppose, reason why we're encouraging people to look at this area, particularly while children are relatively young. Because the key thing that I would say to anyone is that you need to give time to these things to enable them to grow and to give you the best opportunity to actually get benefit from these schemes. So I've thrown up a slide there. It just talks about, I suppose, the costs that I suppose a lot of us probably are facing or are likely to face as our children get older. It also, I suppose, relates to grandchildren as well, for any people that might have grandkids, that they are an expensive, I suppose, part of our monthly budget. I have 3 children myself, and typically between the costs of private education, my oldest son started Christians there 4 years ago, which came at a bit of a surprise to the general, I suppose, things that most parents have to bear costs for. They suggest that it typically costs somewhere between 20 and 30,000 to put a child through 3rd level education. Now, those costs can vary a lot depending on whether your child stays at home or travels. Really, the point I'm trying to make is that it makes sense for, I suppose, people to try and put a certain amount aside to be able to cover those costs. And there's a lot of statistics around this. That slide I've just put up shows you what the annual costs tend to be when putting your children through school. And I appreciate for a lot of parents it's a case of making ends meet, but the whole purpose, I suppose, of today is to kind of help you have the right, I suppose, ammunition to be able to make this, I suppose, pain more tolerable. So just to summarize, really, in my view, I think that the banks are going to be really challenged for the next 3 to 5 years. And I when I use the word banks, I'm talking about the accounts with the credit union, the post office. Not that I have an issue with the credit union or post office, just that the returns are negligible. And my role as a financial advisor is to enable people to essentially get more for their savings and get their money working harder for them. And as you can see from this slide here, since really, I suppose, the middle to early part of the last decade, we've had this kind of situation of essentially 0 and now negative interest rates. And that isn't going to improve anytime soon. I have a lot of parents who have typically saved in the credit union and the post office. The post office, say 5-year savings bonds, are now paying on average about 1% per annum. And although it's a tax-free return, in my opinion, it's barely going to cover inflation. And hence why I am suggesting to people that they should be looking at alternatives. So how can you grow your savings? Well, as I said earlier, the account that I'm going to recommend to you today is through Zurich. And I feel that the Zurich savings plan really is the most purpose type of policy. And as you can see there, for an adult who looks to save a figure of 300 euros a month over a period of, say, 5 years, is typically looking at getting returns in the region of around 20,000. But by investing that money, and when I say investing, it doesn't have to be particularly risky investing, and this is where it comes down to advice. You can opt for different options, but you can see, again, quite clearly the difference of putting that money to use. And it can be something as significant as a difference of a figure if you left it in a cash or post office or credit union account in the order of about 18,000 to something north of 20 to 25,000 euros. Again, these figures are just illustrative, and I would be happy to go through them in more detail. With respect to sorry, and I'm going to go through some of these slides a little bit quicker. A lot of people are, I suppose, are weary about investing money, particularly when it comes to their children. I can only talk from experience that as a parent and obviously as a financial advisor, one thing we need to be, I suppose, aware of is that as long as we have time, and what I say to any parent is that if your child or children have typically at least 5 years until they are due to reach 3rd level education, in my view, it would be useful and sensible for them to have accounts that have the ability to make a return. Parents often ask me, are these accounts guaranteed? And my response to that is no, they're not. But they can be mitigated insofar as the level of risk that somebody's prepared to accept. But as you can see from this slide here, the average returns over a longer period tend to be higher and they're more consistent. And for me, for anyone who is looking to either set up an account with Zurich or look at this as an option. My suggestion is that per 100 euros that you save, you should be looking to accumulate 5 euros per annum. So if you think about it in very simple terms, 100 euros a month, 1,200 euros over the year, over a period of 5,000 euros is 6,000 euros. That would typically provide you a return of north of 7,000. The equivalent in the banks is going to give you very little over the 6,000 euros that you would have, obviously, by leaving it in that place. So to cut to the specifics, the plan that I'm going to talk to you about for the next kind of 10 minutes or so enables you to save from a little as 75 euros a month. A lot of parents, I suppose, try and adhere to put in the child allowance in, which, as most of you know, is 140 euros per child. But again, these plans are flexible in that they give you the opportunity to actually make changes as your situation dictates. So what we're saying to clients, or I suppose parents, are that if you start out by saving a certain sum, you are not mandated to keep at that level. You can increase the level that you save, you can reduce it, you can put it on hold, you can put lump sums in. For example, if your children get I suppose a present from a relative, or indeed for things like communions or confirmations, and importantly, you can actually withdraw from it without penalty. So if, for example, let's say deposit rates did go up back up in the banks, there is nothing stopping somebody taking the money out of the Zurich account and placing it back there. And as I said earlier, in my opinion, I don't think that's likely to happen, certainly not for the next 5 years or so. Now, I just want to touch upon this slide with you, and I think it's really important. As I said, the idea sometimes of parents risking, and I suppose if I use the word risk, their children's third level education money, their inheritance, whatever it might be, the key thing I would state is that, as you can see from this chart, risk and reward are correlated. So if you're looking at, zero risk, you're looking at zero return. And obviously over a period of time, that essentially means a negative return, because inflation is going to erode the value of that money. I find it hard to, I suppose, fathom why people put money into the post office for a 10-year savings bond, paying 16% over that period, which, if anything, is going to lose money because inflation is just going to eat into that. So again, what I'm saying is that, particularly for those who are paying monthly into these accounts, you're essentially drip feeding money over a period of 12 months, 5 years, 10 years on a regular basis, and that in itself does reduce risk. For most savers, I suggest that you would go in at a medium risk level. So on the scale of 1 to 7, you can see there typically a risk profile 4. And if you look at the numbers above that, you're looking at a return range of about 5 to 10% per annum. Now, because interest rates are so low, I would err on saying that typically that return would be more closer to 5% rather than 10. But again, if you think about the effect of compounding of 5% of a return on your savings year after year, it's much more impressive than that. Now, for those of you that say, okay, well, Nick, how can we make 5% a year? Surely there must be some risk to that. And I suppose the risk that I would say that you would potentially face is that, yes, you could lose 5% a year as well. Now, whilst that doesn't sit well with a lot of people, the key point I would make is that if you think about it, put in 100 euros a month as an example over a period of 12 months, typically 1,200 euros paid. That means that potentially your savings fund for your kids could be worth, say, 1140. So it's 60% of a reduction, 60 euros of a reduction. It's a very small, I suppose, risk to pay with the view of the return that you could generate from this. Now, I have many clients who are invested in a lower risk profile, and obviously our job in Alpha Wealth is to manage the money for parents and to make sure it's appropriate to their requirements. For my own children, as my kids get older, I'm looking at reducing the level of risk. So for example, I've set up one account for the 3 children, and I'm just bundling the money into that account for all 3 of them. As the oldest child, my son, gets to an age that he's going to need the monies, I'm going to reduce the element of his savings to a lower risk level, just really to safeguard that piece for him when he may require it. And then I continue saving on a regular basis on for that purpose. And what I like about these accounts are that they're very flexible, because they allow people the opportunity to add. And indeed, children go through a process of maybe requiring this money over a period of 2, 3, 4+ years. Many parents, I suppose, in this climate are starting to help their children when it comes to saving for a deposit for their first house, which again, this account would be ideally suited to, because it's open-ended. There's no fixed time frame. It allows, I suppose, flexibility, as I said, insofar as if you choose a fund that you go into, say, for example, you go into the level 4, which is a medium risk fund, that can be changed on any given day without any cost. And as I said, for myself and David and the other guys in Alpha Wealth, our role is to manage that account for you. You do get online access. You can visibly see the account on a daily basis, and it's very clear and visible. In respect of the costs of this account, so Zurich provide this account and enable individuals to benefit from their expertise. Now, I'm not going to dwell too much in today's session about what they're doing with that money, but typically, depending on which number you opt for on that risk profile, will dictate where Zurich will place that money. If it's in a lower risk category, it tends to be more focused on cash and company and corporate bonds, which are lower yielding assets but more secure. And the higher that somebody goes up that risk scale, the higher the level of risk typically that they would face, insofar as that there's more risk assets placed, typically what tend to be instruments like alternatives, such as Zurich buying into markets such as gold, oil, and shares. Now, again, the word shares sometimes, confuses people, but investing in shares over a 5, 10, 15-year period enables people to benefit from the performance of these very large companies, which will perform over time. So to give you an example, if you were to invest in the Prisma 4 fund in Zurich, which is the fund of choice for most of my clients, that would give you roughly about 50% in shares. But of that, about 150 companies are opted for, which tend to be the bigger companies, the likes of Apple, Amazon, Google, and so on. Now, to put it in context, the largest holding, which is Apple, because it's the largest company, tends to carry about 1.5% of the overall weighting. So that'll give you a sense of how diversified these accounts are. I'm going to put up a slide here, guys, and sorry, you'll have to bear with me because I'm going to have to come out of this screen and I'm going to put up another one. I just want to show you in terms of how Zurich manage monies and the way in which these things can operate for you. So bear with me for a second, sorry. I should have called this slide up. And by the way, I should have said that if anyone does have any questions, please feel free to ask me at the end. There is a chat facility, which I see some people have already looked at and taken advantage of. If we don't get around to responding to these during the webinar, we will certainly endeavour to do that as we progress forward. Now, I'm just going to share another screen with you. Hopefully you can see this. This is the Zurich Easy Access brochure. Basically, as it states there on the front of the brochure, it's available for lump sum investments and also for regular savings. And the key aspects of this account are that it enables you to get access to your money when you require. It also gives you the facility whereby your money can work harder than sitting idle in the bank. And what I like about this account is that it allows the facility to make changes. And if let's say during COVID, somebody wanted to reduce the level of risk, they have the ability to do that. And this is where the advice piece comes in from Alpha Wealth. We manage this. I'm 47 myself, so I'll be in the company for many years to come. We want to try and provide continuity to clients, make sure that they feel comfortable and safe with where their money is being invested. And as equally as this applies to parents, I'd say it applies to individuals. This savings account is available through any of the brokers operating in Ireland. Why would someone do it through ourselves? Well, I'd like to think that it's based on the advice that we can give you, but also that it's down to fees. We are very transparent insofar as we provide advice to our clients, and we show them, and if anyone wants to progress this, we provide a recommendation to them which they can read, and it clarifies very clearly what the fees are associated. For anyone who's on this call, we are offering an extra 1% bonus, which means that if you save into this account, all of your money is invested. Now, the 1% bonus that we're covering, which is not normally provided, will cover a 1% government levy. There is no other broker in Ireland that I know of that will do that. As well as that, many brokers in Ireland, and I'm happy to be tested on this, will take at least 2 or 3% from someone's initial investment. We at Alpha Wealth do not do that. The only cost of this account is a management fee, and that management fee for regular savings is 1.5% per annum. So based on the illustrations that I've gone through with you, what we're saying is that we believe very firmly that on average, in a medium risk capacity, people should be looking at a return conservatively of about 5% per annum. That would have been the case even with what happened this year in COVID. So if I had spoken to someone a year ago, and if they had set up this account with me, they would have made 5% over the last 12 months, which is fairly phenomenal. And in my opinion, Zurich were the best manager in that period. And I can prove that if anyone would like me to. But I suppose the point I'm trying to make is that even less the management fee, it is significantly better than it is by leaving it in the bank. And with the compounding and cumulative effect of that over a period of time, it's very significant. The final thing I just wanted to talk about was tax. Now, this account can be placed in children's names. Again, myself and David and anybody in Alpha Wealth would be happy to explain the mechanics of this, or it can be done as parents and then be provided to children when they require. And we'll give you advice as to what the best thing to do is. As I said, we don't charge for that. And the few things to, I suppose, to warrant are that, you know, again, and I'm happy to prove this to anyone who wants to see my own policy schedule. I am a great believer in Zurich. I really like their investment fund managers. We have about 95% of our savings accounts with them for right reason. I think they're very progressive. I think they've dealt with the, I suppose, headwinds that we've faced. And more importantly is that we're coming into a period now where, you know, thankfully we've had some good news over the last couple of weeks around the vaccines. Markets have stabilized, and I think there really is good opportunity for people to benefit from their expertise. And if anyone believes that markets are going to fall over the next while, what I would say in that instance is, I assure you, Zurich are very much on top of that. And I do believe that they are investing in the right areas where they feel there's opportunity. It was very apparent to me during COVID about the way that they redress their portfolio, move into more stay-at-home stocks, and they're very progressive insofar as explaining to people on a very regular basis what they're doing. So this comes back to the transparency. I just want to finish off, because I'm conscious of time today, that as I said, David and myself are happy to run through the mechanics. We can send you on some information after this webinar as to this account, and obviously include the brochure. What we're also, I suppose, reminding people of is that even if you have a savings account already for your children, it's worthwhile just reviewing it. More so from the fact that I come across a lot of clients who have savings plans with the likes of Irish Life, Aviva, maybe with Zurich already, but it's a case of checking what fees you're paying. Because if you have an account set up already that you're paying a 3-4% entry fee to, and a management charge of 1.75, and I've seen 2% per annum, it's going to erode the return that you're going to make. And it's really difficult particularly when investment markets are not giving as high returns, to actually make money. And more importantly is that you don't want that obviously to be taken in fees. The other final thing to finish off on is that we do provide other advice, as I said, and obviously we're saying to parents that it's worthwhile just checking in where you're spending your money, in that, you know, reviewing your protection, for example. It is an area that I suppose with the climate that we find ourselves, it's worthwhile people just noticing what they have. And it's not about trying to sell policies to people. It's about people just saying to themselves, okay, well, what cover do I have? Am I paying too much for it? Is there a more tax efficient way of me getting the same level of cover? Is there a policy that I took out previously that maybe I don't need anymore that I can apply to maybe the savings account? You know, and it's really about redressing where our money is going. And again, you know, as financial advisors, we provide that. It's funny, I've been speaking to a few people who mentioned Owen McGee, who I used to work with in Ulster Bank many moons ago, and he's on the television now, as some of you may have seen. And it's the same type of service, but importantly, we don't charge for that. And again, it's an area that I'm suggesting that we offer a 30-minute complimentary Zoom financial clinic for anyone that would like to get some advice from us. There's no obligation to take it. And what we do is we provide you with a very simple report at the end of the Zoom, just detailing really a few areas that we feel that maybe you can improve upon. And it might be something as simple as saying, well, okay, Nick, I'm, you know, part of a company pension scheme. Should I be looking to make an AVC payment before the 10th of December, which is the cutoff point for this year? Or, you know, I worked for a previous employer. Can you help me get some information around, you know, where my scheme's at? And am I appropriately in the right account for myself? Or something as trivial as, you know, their car insurance is up for renewal. We don't sell car insurance, but we broker that for clients. And I suppose it's really a case of just being able to help people along the way and enable them to, I suppose, get their money best working in the right areas. So I do appreciate your time today. I know it's been a difficult few weeks, and hopefully we only have a couple more weeks left in this particular cycle, and we can all get back to some sort of normality and enjoy Christmas. I'm going to, I suppose, open the floor up. If anyone would like to ask any question, please feel free to unmute your mic and ask me. If there are, as I said, any questions that, you know, we haven't answered on the chat, we will endeavour to get through them all. And if anyone wants to send myself or David an email around any of the things that I've covered off today, or indeed any of the other areas of financial planning in whatever aspect, what we're really trying to do, guys, is just help people in whatever capacity, in whatever area of finance that might suit them. Obviously, any of the information provided to us is completely confidential. We are regulated by the central bank, and we provide us, I suppose, we pride ourselves in providing a very professional service. So, as I said, thank you very much to you all. And if anyone would like to ask any questions, please feel free to ask me now.
Nick, sorry, this is Dimitri. Can you hear me?
Yes, I can. I can, Dimitri.
Could you repeat just shortly what was the tax implication? I think I was distracted for a moment on this one.
Oh no, and sorry, I probably didn't cover it off as clearly as I should have done, Dimitri. So essentially, for any growth that this account makes, the current rate of tax, which is only payable on exit. So the advantage of it is that if you leave this money alone for 3, 4, 5, 6, 7 years, there is no tax taken up until the point that you withdraw. The tax rate is done at source, so Zurich will deduct that, and the rate is currently 41%. So to put it in specifics, let's say you had saved an amount of 15,000 euros over a period of, say, 5 years, and the value of your savings was 20,000. That's a profit level of obviously 5,000 euros. And the tax that will be deducted at source is 41% of the 5,000, approximately about 2,000 euros. Now that may seem high, but as I said, the benefit that you've had is the years of cumulative, compounding on the, growth and gross amount. Now, there is a view that the exit tax rate may fall in line with capital gains tax, which is currently 33%. And it was due to be, I suppose, raised in the last two budgets. It was taken off the 2019 budget because of Brexit, and it was taken off the last budget, obviously because of COVID. But my own view is that there's been a lot of clamoring from the insurance industry about the rate of tax. But the point I'd make to anyone is, in the example that I described to you, which is not unrealistic, by the way, making 3,000 euros net over that period is far more significant than the return you'll get in the bank. And I suppose the unfortunate thing is that it's very difficult to avoid a tax man. So it's important to know, and I'm not a fan of people paying tax, and my job is to find, I suppose, the best ways in which we can mitigate and reduce it. But there's no other options really for regular savings. I believe firmly that by saving with a manager like Zurich in a well-diversified fund, and yes, suffering tax at the end of it, is the only way to go. I truly believe that. Does that answer your question, Dimitri?
Thanks, Nick. Yeah, it did.
Can I ask a related question here? This is Maria.
Hi, Maria. Yes, of course.
So you mentioned earlier that the post office 10-year bond with the 16% at the end, I think, is it? That doesn't compare at all to the type of regular savings from Zurich. But in that context, isn't the post office one tax-free? So could you take us through the example that you just did there, but with that one, just so I can compare, because I still don't understand how.
Yeah, that's a good point, Maria. So just to clarify, firstly, the post office solidarity bond, as it's called, which is a 10-year bond, it's a lump sum account. So you could potentially put in, say, 1,000 euros a year as lump sums. It's not for regular savings, but the principle is the same. As a parent, if I had 1,000 euros and I was looking to leave the money in for 10 years, would I opt to put it in Zurich, or would I go to the post office? And I suppose the reason why I'm recommending against the post office is that 10,000 euros will only accumulate 16%. So that's 1,600 euros over 10 years, albeit tax-free. With the return that I would expect from Zurich over that 10-year period, which, as I've described it, even in a conservative fashion, should generate about 3.5% per annum on a compounded basis over that time, it's going to significantly outweigh that, probably to the tune of about 3 times. So to even break it down, in a more simpler form, what I'm saying is the post office will pay you 1.6% per annum. That's evident. That is the rate of return per year on a simple interest basis. It's not good enough for me. I'm not prepared to give the money for 10 years to earn 1.6%. I would prefer my money to work harder and to earn a better return. And the point I'm making is that with long-term accounts, which this Zurich account is really destined for, I can show you any period over history over the last 100 years, pick any 5 to 10 year period, they would always outweigh the returns that the post office are paying. So the problem I have with the post office is, in times where we face, which is very low interest rates, you're locking money away for 10 years at very, very poor rates. Because I suppose respectfully, Maria, that rate of 16%, about 3.5 years ago, it was 50%. That'll tell you how much these accounts have fallen by. Now, that might change again in the next 3 to 5 years. And if it does, I'd encourage you to go back to the post office, but certainly not at the moment. Does that answer your question?
Yeah, great. Thank you.
No problem. Listen, I appreciate your questions, guys. They were very relevant. As I said, I'm going to do another one of these webinars in January, but if anyone would like to get more information from us, and obviously, I appreciate you taking the time today, and obviously David's available as well to run through the specifics. But look, I wear my heart on my sleeve. I can say to you all honestly, this account is the best bar none. And really, whether you do it through Alpha Wealth or through someone else, I would encourage you to explore it. It has so many great features. It's flexible. You could pay 1 month's premium into it and decide it's not for you and take your money and leave. That's fine. But it allows you the opportunity to make money. And in a climate that we face, that has to be worth looking at. As I said earlier, why I feel you should do it through Alpha Wealth is that we are a low-cost broker and we provide a really good level of service to people. And as I said, it's not just for parents. You know, I would suggest that somebody would do this for themselves, because we all have a requirement to save, whether it's for a holiday in a couple of years' time, hopefully we can all travel, or if we want to buy a new car. It's about making sure that we have the right provisions, and it's about balancing the money that we earn. And a lot of us haven't been able to spend money over the last 8 months. And really what I'm saying to you is that, in my opinion, it makes sense for us to put it away. Now, I caveat by saying, if anyone is looking to spend this money in the next 6 months, let's say you're saving for a house, it's not long enough. With the greatest respect, as much as it pains me to say this, anyone who needs money within a 12-month period, they should leave it alone in the bank. Anything beyond that, then yes, it's worth exploring. Is that okay? So listen, I appreciate your time. Thank you very much. And I hope you all have a good weekend. And as I said, we will respond to any queries. And if anyone would like to just ask anything at all, don't hesitate to either give myself or David a call, or indeed pop us an email. Thank you very much. Enjoy your day.
Thanks, Nick.
Thank you.